Have you ever wondered where money really comes from? Most of us think it's printed by the government, right? Well, that's only a tiny part of the story. The truth is, the vast majority of money in our economy isn't physical cash at all. It's digital, and it's created almost like magic by commercial banks every single day. Stick with me, because what you're about to learn will change the way you see money forever. Let's get right into the heart of it. When you walk into a bank and ask for a loan, say for a new car or a house, what do you picture happening? Do you imagine the bank manager going into a vault, counting out stacks of $100 bills that other people have deposited? That's a common misconception, but it's not how it works. In reality, when a bank approves your loan, they don't take money from anyone else's account. They don't use their own reserves. Instead, they simply type a few numbers into a computer. In that instant, new money is created, credited to your account as a digital deposit. You see the balance in your account, and you can spend it just like any other money. This newly created loan is now an asset for the bank, and your promise to repay it is their security. It's a mind-bending concept, but it's the foundation of our modern financial system. The Bank of England itself has stated that around 97% of the money in the economy is created this way, by commercial banks making loans. So how is this possible? The system that allows this is called fractional reserve banking. The name sounds complicated, but the idea is fairly simple. When you deposit your salary into your bank account, the bank is legally required to keep only a small fraction of that money on hand, in reserve. This is the fractional reserve. The exact percentage varies by country and economic conditions, but it's often around 10% or even less. What happens to the other 90%? The bank lends it out. Now here's where the magic of money multiplication begins. Let's walk through an example. Imagine you deposit $1,000 into Bank A. The bank keeps $100 or 10% in reserve. It then lends out the remaining $900 to someone else. Let's call her Sarah. Sarah uses that $900 to buy something from a store owned by John. John then deposits that $900 into his bank, Bank B. Now what does Bank B do? It follows the same rule. It keeps 10%, which is $90, in reserve, and lends out the remaining $810. This process continues, with each new loan creating a new deposit, which is then lent out again, minus the small reserve. Your initial $1,000 deposit can ultimately support the creation of up to $10,000 of new money circulating in the economy. It's a chain reaction, a multiplier effect that expands the money supply far beyond the initial amount of physical cash. Each time a loan is made, the money supply grows. Each time a loan is repaid, the money supply shrinks, because that digital money is effectively destroyed. This system has huge implications for our economy. On one hand, it's what fuels economic growth. This ability to create credit allows businesses to invest in new factories, entrepreneurs to start new companies, and families to buy homes. It makes our economy dynamic and flexible, allowing capital to flow to where it's needed most. Without this credit creation, our economy would be much smaller and slower. It allows for a level of investment and consumption that would be impossible if we could only use existing physical currency. When the economy needs a boost, central banks can lower the reserve requirements or interest rates, encouraging more lending and thus more money creation. However, this system also has its risks. What if a large number of depositors suddenly wanted to withdraw their cash all at once? This is called a bank run. Since the bank only holds a small fraction of its deposits in cash, it wouldn't be able to pay everyone. This is what caused widespread panic during the Great Depression. Today we have safeguards like deposit insurance, where the government guarantees your deposits up to a certain amount, which helps prevent such panics. Another major risk is the creation of asset bubbles. When banks lend too easily and create too much money, it can drive up the prices of assets like stocks or real estate to unsustainable levels. When the bubble eventually bursts, it can lead to a severe financial crisis, like the one we saw in 2008. The system relies on a delicate balance of confidence and regulation. Banks must be prudent in their lending, and regulators must watch carefully to ensure the system remains stable. It's a powerful engine for prosperity, but if it runs out of control, it can cause immense damage. Now let's connect this to our everyday lives. Have you ever wondered why interest rates are so important? When you hear on the news that the central bank is raising or lowering interest rates, they are directly influencing this money creation process. Lower interest rates make it cheaper for people and businesses to borrow. This encourages more lending, which creates more money and stimulates the economy. Higher interest rates do the opposite. They make borrowing more expensive, which slows down lending, reduces the amount of money being created, and helps to control inflation. So that seemingly small percentage change announced by the central bank has a massive ripple effect throughout the entire economy, all because of the way money is created through loans. Furthermore, understanding this helps you see debt and credit in a new light. When you take on a loan, you are participating directly in the creation of money. When you pay it back, you are participating in its destruction. This also highlights the immense power that commercial banks hold. They are not just passive intermediaries holding money and passing it from savers to borrowers. They are active creators of the money we use every day. Their lending decisions, who they lend to and for what purpose, directly shape our economy. They can fuel a boom in the tech industry, a housing market expansion, or even speculative bubbles, all based on their willingness to create new digital money in the form of loans. This challenges the traditional view of a bank as just a safe place to store your savings. So, to recap the incredible journey we've just been on, money is not just printed paper. The vast majority of it is digital credit, created out of thin air by commercial banks every time they issue a loan. This is made possible by the fractional reserve system, where banks only keep a small portion of deposits on hand and lend out the rest, setting off a powerful money multiplier effect. This system is the engine of modern economic growth, but it also carries significant risks that require careful management and regulation. It's a system built largely on confidence and the promise to repay. The next time you swipe your credit card, apply for a loan, or even just check your bank balance online, remember what's happening behind the scenes. You are witnessing a fundamental, yet largely invisible process that shapes the wealth of nations and the financial reality of every single one of us. It's not a conspiracy. It's just how the modern banking system is designed to work. But knowing this gives you a much deeper and more powerful understanding of the financial world around you. It's one of the most important and least understood aspects of our economy. Thank you so much for joining me on this deep dive into the world of money creation. If you found this as fascinating as I do and want to uncover more financial secrets, make sure you hit that subscribe button and turn on notifications for FinSparrow. We're on a mission to demystify finance and empower you with knowledge. Got any questions or ideas for our next video? Drop them in the comments below. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.